Lowrance. I work in Citi's Environmental and Social Risk Management Unit, and we currently chair the Equator Principles Association, which is comprised of about 69 financial institutions globally that have committed to a common due diligence framework which is underpinned by the IFC performance standards. And so I think through this association there's a great opportunity to affect change in environmental and social impacts in the way we look at them. The first thing that I want to share is that in project finance, commercial banks rely on the environmental and social impact assessment to identify the risks and impacts. That's the cornerstone of the due diligence that is performed. And in the absence of government policy, it is rare that EIAs contain any kind of substantive climate change analysis that I've seen. And so consequently, this has in the past few years led commercial banks to develop a number of initiatives to address these risks and impacts. And these initiatives range from principles-based approaches like the climate principles to due diligence frameworks like the carbon principles. And what makes them unique, I think, is that it's the collaboration of an entire sector or a subset of the sector to adhere to environmental and social norms. And so I'll tell you a little bit about one of them. It's in 2007, actually, Citi was one of a few US banks to identify the need to better assess risks associated with climate change in the utility industry in the US. So Citi, JP Morgan, Chase, and Morgan Stanley convened a meeting with two NGOs, Environmental Defense and Natural Resources Defense Council, and two of the largest coal-fired power utilities who are our clients, Southern Company and AEP. And together they developed a framework over a course of a year to address really regulatory risks associated with financing coal-fired power plants. This is an old story. The carbon principles were launched in 2008. But I think what's unique and what, at least within Citi, what we keep coming back to is that this is a framework that takes environmental externalities and incorporates it into the financial model so that we actually are accounting for the costs of climate change impacts primarily. I think at the time, adaptation was not really on the radar screen for us. So the end product was a common framework. We were joined by Bank of America, Wells Fargo, Credit Suisse, and all of these financial institutions agreed to consider things like the evaluation of technology and energy efficiency options, the effect of integrated resource planning on a project, the sensitivity of a project to potential carbon costs, so carbon shadow pricing, that's not too new. But also we started making assumptions about the feasibility and the cost implications for carbon capture and storage. What does it cost to retrofit? Do we need infrastructure at this location to move carbon dioxide to a geological storage area? And then finally, we evaluated mitigation plans associated with these financings. And it really moved banks out of the realm, certainly of financing projects, into looking at their clients on a much broader portfolio basis. So the bankers started having discussions with their clients about retiring older units and how the client is reducing their exposure to carbon across their portfolio. All of these things can then be modeled not only into the financial analysis for a project, but also into the valuation of the company. So again, I said this is sort of this is old news, but we're actually looking to, I think it can be applied in other sectors like the oil sands, for example, or any carbon intensity, intense sector. And so I'll give you also a little bit about what has been going on recently with the Equator Principles Association. And then I'll end with some of the things that I've heard, some of the key messages I've heard from my fellow panelists. The first is that, as I mentioned, we have a climate change working group within the Equator Principles Association. Our primary function is to provide input to the IFC during its performance standard review. And a number of questions arose during that process that have no easy answers, and I'm actually hoping that I can get some good ideas and potential solutions to these questions to pass on to my Equator Bank colleagues. But some of these are when an Equator Bank gets an impact assessment that does not have climate change considerations, what should be the triggers for us to go back and say, we need a supplementary study? Should climate impact assessments be standalone, or can they be standalone? How do we define best available technology, balancing energy, environmental, and economic impacts in different countries? In other words, how do we evaluate the energy efficiency performance in a local context in the absence of country-specific data? Again, it comes back to the need for more data. And how do we balance environmental trade-off when mitigating air emissions, which may require large amounts of water or energy penalties? So these are just some of the questions that Equator banks have been grappling with. And now I'll conclude with also some of the key messages I've heard today and this morning, and then we'll move to questions. The first is that there is any inaction by policymakers is likely to lead to increased liability and litigation. And I have a question about that a little bit later. The second is we are moving into a realm of increased risk, and we need to work together, particularly with the financial sector and the insurance sector. And the third and final thing is, a key message for me, is that natural capital is being eroded, and that there's no longer a free ride, as Peter said, with regards to ecosystem services. I think ecosystem services is a really underestimated impact or risk to business, and it's something that I think we're going to see a lot. We've seen a lot in the past year, but we're likely to see a lot more in the coming years. So I will stop there and take any questions.